Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark checks out this week's equity markets. Institutional Advisors Chief Investment Strategist Bob Hoye comments on the status of commodity investments and whether central banks can control national economies. We'll speak to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Good to be with you, Jim.
Janet Yellin, apparently the biggest influence on the world's economy.
Yes, and she's talking quite devishly these days, still talking about being data dependent in terms of what they're watching, and the numbers that they're looking at are not just the domestic ones anymore. They are really talking about looking at the whole world. They want to be the central bank to the world, and from what came out of the speech on Tuesday, it was taken as such that don't look for an interest rate hike this June, probably not in the fall, and possibly into December, depending upon how things go. But here she is. She's, the Fed is watching data, and they're watching the markets, and the markets in turn are watching her. So who knows? This is a big, just a circle of everybody watching everybody else. And when you saw the data this week in terms of the employment numbers, the market got hit initially, came back very well at the end of the week, a big positive week. Puts the S&P, from my perspective, up into a pretty hefty resistance area. Anything in the 2070 to 2100 level should have some pretty big overhead resistance. And we are now into April, which from the seasonal perspective is where we've been looking for this election year to do a bit of a roll up here and get the next correction in place.
Oil, what's going to happen there? It had a nice little rise.
It's had a good ride up to that 40 to 42 level, rolled over at the tail end of the week here. Interesting, you've got positive news on one side. The rig counts are now the lowest level in, I think, something like 40 years. On the other side of the coin, it looks as though production levels are going to start to go up. From OPEC, nobody's there talking about dropping productions. So technically, markets pulled back to the $36.50 level, and originally we've been thinking that we could pull back into the lower 30s. Right now, it looks as though this $35 to $36 range should be a pretty good support for now.
Was the Trudeau government overly optimistic when they planned their budget on $40 oil?
Well, they've been better off to do what Paul Martin did in the past. Under promise and then come through with better numbers when the economy is better than you anticipate. I think they'd have been better off to budget off of $25 or $30 oil. But we'll see how this unfolds, and time will tell. As far as the dollar is concerned, the Canadian dollar, with what we saw in the U.S. Early in the week from Yellin, all the currencies moved up against the U.S. dollar. That was the Europeans, the Japanese, Canada just tailed along with everybody else. And for all that we like to look at country-specific news for Canada, when I compare our price action to that of the Australian dollar with a similar type of economy, resource-based, they are moving pretty much lockstep with one another.
Gold prices and gold shares have had a nice rise this year, a bit of a correction now.
Yes, it's interesting. Gold has had a couple of news events here in the last few weeks. A week and a half ago, you had the Belgium terrorism attacks. The two there caused a blip up in the gold market for one day. That was shy of the highs that it had put in earlier in the month. Then again this week on the Yellin comments regarding interest rates and the action in the dollar, we had another blip in the gold market, this time only up into the 1240 range. So it's been given enough good items that if it was really strong, I think we would have continued higher. But there's definitely a lid in there right now, and you've got fairly large commitments already by the speculators. The speculative long position is now the biggest that it has been since November of 2012. And with prices boxed in here in this 1210 to 1280 range, I would suspect that if that support level at 1210 is violated, that your next support level is going to be a good $40 or $50 below that, probably into the 1160s. And it would only take one piece of negative news, I think, to spark that. Now, the stocks, the GDX, the XAU, if you look at those, they've been holding up exceptionally well. But, their support areas are fairly tight in here as well. So if they give up ground, you'd expect to see those stocks give up, I would think, a good 50% of the run-up that we've had in the last month and a half. Maybe not all the way back to the December lows, but correct at least the most vertical part of the rally that we've just seen.
Ross, thanks a lot for chatting with This Week in Money.
And we will see you again next week, Jim.
Coming up, Institutional Advisors market historian Bob Hoye on This Week in Money.
Always consult your investment professional before making any investment decision.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to This Week in Money, Bob.
Jim, good to be with you and good to be with our listeners.
How have the stock markets been performing so far this year?
Well, it's been pretty psychotic. Schizophrenic, I guess, is the better term. One of the worst openings to a year in history. This was a continuation of the peak in the markets in, various sectors peaked between May and July. And then it was the disaster in Shanghai that pulled it all down. And of course, this was all preceded by by credit spreads, which is the difference between high-grade bonds and low-grade bonds. And when everybody's confident, that spread narrows, and until it gets too much, and then when they reverse. So then our work in June, we were looking for credit spreads to reverse to adversity, and then make certain technical objectives through July, which they did do, and then that was then prompted the liquidity crisis that was focused in Shanghai and China markets. Man, they were speculating in iron ore prices and all kinds of things, commodities. So spreads started to widen, and then they widened relentlessly and bring the whole house of cards down to late August. That was August 24th, which was the crisis day, and the financial pundits labeled it as Black Tuesday. And then there was relief in the markets around the world, and then you had them heading down again, such that December and January were very bleak. By this time, the financial markets had got, and particularly the stock market, was hanging on commodity prices, and crude oil was heading down. Just to back up on that, Jim, in 2014, our forecast was that crude oil could fall to 1/3 or 1/4 of the high that it reached in 2014. So it reached 107, and the 1/3 level was 37, and then the falling to 1/4 was 27, which actually the low was 26. So anyways, this then forced a lot of selling because everybody was leveraged, particularly on the crude oil side. A lot of the oil stocks were owned by institutions who were playing the idea that there's always going to be a crisis in the Middle East to drive crude prices up, and they didn't understand that the whole pricing of crude oil had changed because of technological innovation. So down came the crude prices, and down came the credit markets, and with some pretty heavy selling right into January. And then that was overdone. The markets cleared themselves, and it took a test, and then you've had a terrific rally. Now, our work at Christmas time was that the decline in crude oil could have has a seasonal component, and it could perhaps bottom in June, which it did do, January, starts with a J. And then you'd get a rebound. Also, you can have a seasonal low for base metal prices down into the December time. So what it depended on, of course, was crude, and it recovered. And then that launched this rally, which has been terrific. You've had, they're saying that it's been the best first quarter in ages, and it was, if you had to trade it, it would be fabulous, because making money on the short side on the way down is very good, and then covering and getting long. So anyways, our work on crude oil and on base metals was that it would clear the markets and rally out to around March. So that could be in the middle of March or late March or like now or whatever, when the rebounds would top. So this is what indeed has happened. The price of crude oil was up to 41 or 42, and it's back around 37 now, and slipping below 37 on the chart doesn't look so good. And we got to go back maybe about 15 years ago when crude oil was considered bad. When it went up, they figured that was bad for inflation and stocks wouldn't be so good. But if you take a look at the chart with the S&P and crude oil, they kind of go up and down together. So when crude started to go down in the late summer, some of the pundits got out and said, oh, great, this will put gasoline prices down. It'll be good for the consumer and good for the economy. But our view on commodities is when they go down, it is showing economic weakness, and it doesn't matter how low they get. If there's economic weakness, you're going to get unemployment and stuff like that. So, and that it would take the financial markets down with it. So this, of course, the link there was that in 2012, 2013, and 14, it was about some 17 or 18% of new issues of junk bonds were floated by companies in the oil patch. So then when the price of crude went down and oil companies started having hardship, they then are unable to service the debt, and then that, of course, makes the junk bond prices head down and the yields go up. But then oil isn't a part of isn't an isolated thing. It's part of the economy. So then that's where you then had terrific markdown in junk bond prices across the board, and of course very severe for those in the oil patch. So that then brought us down to January, and here we are out here now, having enjoyed a terrific rally for the base metal side. Some of the base metal companies did very well, and you also had a rally for gold, up something like to the best at 23%, and then the gold index, the gold stock index that we follow is the old Hoye, H-U-I, and it rallied from 99 in January to 180. It was, absolutely incredible, like an 80% rally. And it's been going sideways for a while. So our view on the recovery in commodities is that this is the best probably for the year is likely in, and anybody who played in the stocks have had very good gains and should take some money off the table. And the other one would be that on the, of course, we've been avoiding the lower grade securities since last year when we expected them to roll over. So that's the other side to avoid.
You're listening to This Week in Money. Our guest is Institutional Advisors Chief Investment Strategist Bob Hoye. Standard & Poor's downgraded China's credit rating from stable to negative. The Chinese government has reacted by saying it's an overreaction to their economic state. And the latest statistics show that their manufacturing actually went up for the first time in 8 months. So maybe China has turned a little corner.
Yeah, there's actually things in the U.S. as well are this month a little firmer. Something came into it, improved employment, some operations are better, and then an uptick in China. But I think the downgrading in China is appropriate. Their governance there, it's all very corrupt. The higher up you are in the governing party, in the Communist Party, the more you're involved in ripping the system off. Some of these guys have made billions of money, and they have been interested in keeping the bubble going. And, of course, even no matter how dedicated a government is to keeping a bubble going, once it gets overdone and fails, that's it. There's nothing you can do about it. And typically, the economy will follow. So China's facing overbuild. It's the old story about building empty cities and building empty industrial parks. And we can go back to the 1873 bubble in the United States when it crashed, and it was a big railroad boom. Everybody had to have a railroad. And it was Vanderbilt who said after that, you know, the business of building railroads from nowhere to nowhere is really not a business. And China was building empty cities and empty industrial parks. So somewhere that's got to be realized, that as a major problem. And there's no amount of juicing the financial markets by the central bank that can fix that situation. It just has to resolve itself. So you're sitting in the situation here where you've had great financial manias, which when they're on, everybody believes they'll run forever. And the prosperity is great, so governments like them, and they never do anything to bring one down. And here we are. This financial mania has maximized around the world, particularly focused on last year, May, June. And if you take a look at the New York Stock Exchange with their broad index of the NYSE comp, symbol is NYA, it has set a huge rounded top because not every sector in the financial markets peaked at the same time. And you have this huge rounded top, and you've had a terrific rebound. And when you look at it technically on certain moving averages, this has been remarkably similar to the pattern at the top of the market in 2007, and we're sort of somewhere in the equivalent to 2008 before it really turned bad. So we're watching this very, very closely, and within this you've got like the U.S., their banking sector. And you also have the financial sector called the Broker-Dealers Index. That's the XBD. And it was part of the bull market on the way up, and it's heading down and following the 20-week exponential moving average very closely. So each rally comes in, and it can't get above that declining moving average. So then we look back into 2007, and that was the same thing happened. It made the peak. Everybody was excited about it. came down, and then the first rebound was limited by that moving average, and then the next decline to lower lows. Then the next rally made it up to the moving average, but that was not as high as the previous high. So what it did, when you look at the whole chart on it, it just followed that moving average all the way down into the crash that ended in March 2008. So what we're looking at now is we're just on the second rebound after the peak in last summer, and it's also got quite overbought here on near-term momentum considerations at that resistance line. So we figure that this on the S&P, on the NYSE composite, and on the financials is technically ready to roll over. And also, as we should mention, that where the base metals and oil stocks have had terrific rallies, the financial side with the banking stocks got hit pretty hard. And in Canada, the bank stocks were hit earlier in last year, and they were coming down before the U.S. banks peaked, and now they're all been down. So the banks heading down is a sort of like the pulse of the industry, and the rebound here, where other sectors did very well, the banks didn't do so well, and this is for technicians, this is a concerning item, where a weak group for the last year has only a weak recovery in which turned out for other sectors to be quite robust. So that's concerning. Now then, the other one in there that has been very weak has been the dark side with the IBB index, and it did a huge blow off into May, and then got hit, and it's come down. I just don't have the chart in front of me now. But the biotech, that's the biotech index, and it has had only a modest recovery when other groups have been very strong. So that's another thing that technicians would be concerned about, where you have a seriously weak group, and then on a good rally can't make it, is just not doing it. So these those formal leaders, such as the biotechs, are now, well, let's call them history, or we can call them toast.
Bob, have the equity markets become addicted to quantitative easing?
Oh, yes. But, you know, it's a complex situation. Of course, quantitative easing is the name that they put on their compulsion, the central bank compulsion to force credit into the market. And, you know, I think that for at least the last 15 years, it's been non-stop, even longer application. Because go back to 1994, when there was a financial problem in Mexico, so they flooded the credit New York flooded the credit markets, and they really haven't quit since then. And it's a false premise. It goes back to when the Federal Reserve was started, and that was 1913 when the act was passed. But the promotion then was that people in the financial markets then did see that when you had a setback in the financial markets, it was usually followed by a recession. So these guys, working on intuition, then decided that with a central bank, they could then provide credit to the markets at a timely fashion and then prevent setbacks that would force recessions. So the idea was to eliminate recessions. And, of course, since the Fed opened the doors in January 1914, there's been 19 recessions. So plus an immense bubble in commodities that blew out in 1920, crashed very hard, and then you had the immense financial bubble that concluded in 1929. And then again, you had big runaway speculation in commodities in the 1970s, and then another go up to 2008, and commodities have been coming down since. So they really haven't changed anything. They have these theories that if they ease credit, there'll be a continuous business expansion. But they don't understand that on a business expansion, you do have an expansion of credit because people borrow money to expand business, or then there's also the financial side where people borrow money to get leveraged up on stocks and bonds. But it's not causation, it's correlation. The two occur together. It's like when the old saying that in the morning roosters crowing cause the sun to rise. So this is what the central banks are operating on, is they got this idea that if they push credit out the window, it'll prompt business activity, but that's a false premise, and it doesn't work. Then the other part of central banking is that you have the Bank of Canada, you got the U.S. Federal Reserve, you got the Bank of England. So these all operate on the assumption that there is such a thing as a discrete national economy. And as we know, here with a border 4,500 miles long against the U.S., there's no such thing as a national economy. There's not even a national economy in Canada where you have a manufacturing base in Ontario, and the western part rests upon resource and grains and farming and stuff like that. So you don't even have an ideal national economy within Canada, and there's certainly no such idea as a national economy of Canada that is isolated from whatever's going on in the rest of the world. So we've seen that. When you had a financial crisis and the credit market is global, it changed in July, and that set off selling all over the world. So the two premises for central banking are pretty foolhardy, and it's amazing that those in the investment business have tolerated the thing for so long. But then what it's got down to is that each central bank is just sitting there actually funding an experiment in unlimited government in providing unlimited funding. But we think that the perpetual motion money machine could come to an end on the next contraction. So this is why we're watching this rebound in the financial markets very closely now, because it has met timing targets. We also have technical excesses recorded. So we're just sitting here waiting for prices to decline a little, and that could set then the next the downtrend in stocks. And with that, you're going to get, and it's just actually this week, the credit spreads have started to widen again, which that was the big telltale last summer. And so we're watching that closely. So what you have here is beyond just protecting your money or trying to make some money in the financial markets. What you're looking at would be a very serious critique of the abilities of central bankers. And another recession, and the public's going to take a look and say, look, particularly in the States where it has been so reckless, that what is happening is that policymakers, with their personal theories about how markets work, are gambling with the taxpayers' money. And at some point, the taxpayer is going to figure it out, and it could happen on the next contraction and the next recession.
You mentioned how central bankers think they run things, yet you've cited 19 recessions since they thought they could do things. Do you think they will ever change, and will there be worldwide coordination, or do we need worldwide coordination? The markets work it out for themselves.
No, you don't need worldwide coordination. It's impossible. The markets exist unto themselves, and before the advent of aggressive central banking, the public was perfectly capable of getting highly speculative in stock markets. You know, going back to the 1800s, there was a huge bubble in 1825, another one in 1873 when the senior central bank, the Bank of England, was really quite responsible and accountable and didn't have any theories about managing the world. And so you would have great financial bubbles, and they would get hit, collapse, and then everybody would be careful. So But what you have really coming out of the 1930s is that contraction was so severe, it prompted John Maynard Keynes to come up with some ideas that he thought were new, but he didn't know any financial history. But and one of the early crashes was in 1618 in England, and of course with hardship, there was an intellectual there by the name of Misselden, and he decided that, oh, this is great. The problem is tightness of credit, so if we had more credit, everything would be well. So that's essentially what Keynes came out with in the 1930s, that the problem is that when you have a huge credit bubble, and it's too much credit, and then it contracts, it comes in, and Keynes came up with the idea that you can make the problems of too much credit go away by adding more credit. I mean, the guy was really weird. So here you have this going on, and even Greenspan in 2011 pointed out that the problems and the bust was so bad is because even the central bank forecasting abilities, and he said it was something along the lines, were not very good. So they said that even the central bank is not very good at forecasting, and then they can't respond. So it's a whole mess. So here's where the history suggests is that as this next leg of the market starts down, and then that could be followed by the discovery of even slower economic activity, and then the public's going to say, hey, you've got this theory and it's not working. But, you know, there's more specific, and actually they're collector's items, Jim, that in 1873 in the U.S., that was a great bubble, and then you had the typical stress coming into the credit markets as it was peaking. So then one of the New York newspapers editorialized that in the U.S. nothing could go wrong because they did not have a central bank that was on a gold standard. They had the Treasury system, and the Treasury system could issue any amount of liquidity should there be a problem. So then that was their thesis. Nothing could go wrong because they didn't have a central bank. Then by 1929, on that bubble, one of the leading voices then editorialized that nothing could go wrong as that bubble was peaking. And the reason being is that they no longer had the bad old national system, but they had the new and modern scientific Federal Reserve system, and nothing could go wrong. Of course, we all know you had the crash, and then you had the Great Depression. So as you move forward to 2007, in December 2007, one of the leading economists at Harvard, Greg Mankiw, he came out and boldly stated that nothing could go wrong. And the reason was that the U.S. Federal Reserve System had, in his terms, quote, a dream team of economists at the Fed. So it's ironical that he uttered that in December 2007, because eventually the National Bureau of Economic Research, which determines the beginning and ending of each recession, determined that the recession started in December. And then you went into the crash, which was a crash, and eventually it was bad enough that the establishment did say that this is the worst recession since the 1930s. And then once it bottomed in 2009 and March started to improve, then the establishment went around boasting that without their efforts, it would have been worse. So here you have this contrast. Within 2 years, the establishment says that nothing can go wrong, and 2 years later it says that without their efforts, it would have been worse. As it was, the stock market fell in half anyways, and that's bad enough. Plus, there was huge disasters in low-grade bond markets and preferred shares and all that sort of stuff. So this is something that the public can eventually see. And I think, here, let's come up with a new phrase here. Let's call it, we're looking for a new bull market in common sense in the public. And it's always there, and I think it can come out.
You're listening to This Week in Money. Our guest is Institutional Advisors Chief Investment Strategist Bob Hoye. Bob, what's your take on the Trudeau government's plan to run $30 billion deficits for the next 5 years?
Oh, they are compelled to spend other people's money. That's simply what it is. With the Harper Conservative government in for 10 years, which during that period there was great financial convulsions, and of the G7 countries, the Canadian record was better than the others. But essentially, Harper was trying to bring back the old concept of limited government. And of course, people in Ottawa don't really like the idea of limited government, and there's a whole lot of media that supports them. So what was happening is that they're going around talking it was an austerity program, and somehow this was depriving people of things. No, I still look at it as an experiment in limited government. When the gales of opposition from the left were at storm force, but it ran as long as it could, and then for various reasons it failed, and you had then the whole apparatus of government. You should look at this. That election it wasn't so much the Liberals Party won. It was that the bureaucracy in Ottawa is represented by the Liberal Party. So it's not representing the average person. It represents government. And government is, in their sense, is a cornucopia of goods. I mean, they're going to be handing out what people will think is perhaps free stuff. And then the other side of their tricks is to push superstitions. And of course, one superstition is that government spending is good for you. And the other superstition is that not only can they manage the economy, which we've seen not to be the case, but they can also manage the climate of the planet. And of course, how are they going to manage the climate? Well, through increases in regulation and through increases in taxation. And that tells you really what it's all about. It is the business about carbon dioxide caused climate change. It really has yet to be proved, but it sure puts a lot of money and power in the hands of government. So, hey, a $29 billion deficit is nothing. These people are acting on behalf of the people. They're on a mission, and they know that big government is really good, and that they know how to spend your money better than they do. Gosh, this is sounding like a political editorial.
Well, money and politics seem to march together.
Yeah, and when they're depreciating the currency, you've got bad money and you've got bad politics. So the dollar, Canadian dollar will head down relative to the U.S. It had a very nice rally out of Christmas with the rally in commodities, but now it'll head down. It's really the economists and the politicians like a weak currency because they can borrow money, hard dollars now, and pay them off 20 years with 50-cent pieces. But it's not. A depreciating currency is unkind to most people in the country, and they go around and say, oh, well, it'll help exports, but how far do you have to depreciate the currency to offset the price of crude oil when it falls from $107 to $26? Do they then propose to debase the currency by that much? Of course, it's nonsense. So then you're getting radio stories and news on TV about, oh, this is good for tourists. Well, tourists are not Canadians if they're coming in from outside. So why should Canadians suffer some strange economic theory that is to benefit the people on the outside? It's really, it's an evil that, again, it could be prevented. All you need to do is set up a currency board, get rid of the Bank of Canada, and have a currency board that's there to make sure that the U.S. and Canadian dollars are trading the same at par. So, but there's another little political editorial for you. But no, Jim, actually it's common sense. Throughout all the history back to Roman times, there is plenty of evidence that currency depreciation only serves the state, and it is a great disservice to the public. And I hope they gain some time the public figure out this one and begin to make themselves known, because also one of the parts of the Harper government often mentioned was that they were trying to lower the costs of consumer goods as compared to what they paid in the United States. So, of course, with trashing of the Canadian dollar, you drop it down by 25%, anything you're buying from the States is going to be up to 25% more expensive. So it really doesn't do anybody any good. And but of course, this really becomes felt by hockey players who are in Canada are not getting the same deal as their equivalents in the States.
Well, actually,
but
they
that's
do.
That's an aside.
I was going to say, Bob, NHL players do get paid in American dollars on both sides of the border, but the Canadian ones have to pay up to 20% more in tax.
Oh, yeah, that's what it is.
So it's the taxation that hits.
Yeah.
And also, Bob, another example of a low Canadian dollar, we saw it over the winter, where a head of cauliflower was $8. They used to be like 80 cents.
Oh, yeah, that one, because you had some bad weather in the States, and the groceries from Florida or California, they even went up for Americans. So, yeah, I'm very much against depreciation. It has always been an evil, and unfortunately governments will always practice it because they're always looking for the easy way to do things.
Bob, can you tell us a bit about institutional advisors?
Yeah, we've been providing research, independent research to money managers, fund managers, pension people, high net worth people for since early 1981 is when we got started, and enjoy the business. We cover the credit markets, so that's interest rates, credit spreads, and the yield curve. We cover commodities, mainly because they're so interesting, and currencies, and plus equity markets. And the work has been reliable, I'm pleased to say, over all these years.
Bob, thanks a lot for being on This Week in Money.
I'm always very pleased to be with you, and we'll look forward to doing another one soon.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. That wraps up our show for this week. Thanks to our guests, Ross Clark and Bob Hoye, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.